On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning, team. Hope everyone is well. That's another week done and dusted. Let's talk about everything that happened and then turn our attention to what is coming up. It was a good week for most global share markets. We saw a nice recovery from the previous week, which was much more difficult. So the S&P 500 index in the US bounced back from what was the worst weekly performance in 18 months. Last week, it was up 4%. The tech sector led the charge. It rebounded 7.3%, and it recovered not all, but just about all of the previous week's losses. Other markets performed well for the most part too. European shares up 2.1%, the UK market and the Aussie market both up 1.1%, emerging equities 0.7% higher. The Japanese market was really the only one of the majors which didn't perform well last week. Japanese equities were down 1%. It was a good week for local shares too. We had the NZX 50 index up 1.7% last week. So with about 2 weeks to go, the local market, is up 9.5% this quarter, which sees it on track for its strongest quarterly performance since 2020. Interest rates continued to decline. We had the US 10-year Treasury yield fall from 3.7% to 3.66%, so it's sitting at the lowest levels in more than a year. Local interest rates also fell during the week. The 5-year swap rate was down from 3.6% to 3.5%, so that's sitting at the lowest we've seen since August 2022, a little over 2 years ago. And despite the more positive tone across markets, the Kiwi dollar actually fell a little further against most major currencies. Talking about some of those key releases last week, and internationally, it was the US Consumer Price Index that was in focus. The headline CPI increased 0.2% in August. That was in line with expectations. It was the same as the previous month. However, the core CPI was marginally stronger. It increased 0.3%. That was actually the highest we'd seen in 4 months, and it was slightly above market forecasts. Those increases saw the headline CPI fall further to 2.5% at an annual level. That's down from 2.9% in July, and it's the lowest we've seen since February 2021. The core CPI increased at an annual rate of 3.2%. That was the same as a month earlier. Across the Atlantic, the key event was the European Central Bank meeting, the ECB meeting. And as expected, the ECB did cut interest rates again. It became the first of the big central banks to cut interest rates back in June, and then it paused at its July meeting. However, last week, the ECB reduced its policy rate for a second time, so that saw it fall from 3.75 to 3.5, started out at 4%. That's where it was before that June cut, so now it's down at 3.5%. We have seen good progress on inflation in Europe. The headline inflation rate has fallen to 2.2%. That's the lowest in more than 3 years. So I think we will see further easing in the months ahead. However, not necessarily right away. The ECB does meet next in October, and then it meets in December. So I think you will get another cut before the end of the year, although it might choose to pause again in October and then cut again in December. So at the moment, you've seen cut, pause, cut. You might get another pause and then another cut. But the path is that interest rates are headed lower, but the ECB is taking its time. It's not necessarily cutting every meeting. Here in New Zealand, something that caught my eye was the latest housing market report from the Real Estate Institute. This covered the month of August, and the market is stable, yet it's still quite mixed and it's fairly uninspiring. National sales volumes fell 5.1% from July levels, and they were flat on the same month a year ago, August last year. And another sign of a subdued market, the days to sell increased to 51 in Auckland and 49 elsewhere. Prices were unchanged in August at a national level following 5 months of consecutive declines, and prices nationally are 1.6% above that May 2023 trough, but they are down 2.3% in 2024. Auckland prices increased just shy of 1%, so that's actually the best month for Auckland since November last year. But across the rest of the country, prices slipped 0.6% in August. So it has very much been a mixed bag. Right, turning to the week ahead, and this week is shaping up as a very busy one with some very important events taking place across markets. Central banks will be in focus, and we'll have monetary policy decisions looming in the US, the UK, and Japan. And the Federal Reserve in the US will really be the main event here. It meets on Tuesday and Wednesday in the US, and its latest decision will be released at 6 a.m. on Thursday, New Zealand time. So, just to recap, the Fed funds rate has been sitting at 5.5% since July last year. That's the highest since 2001. But this week, that is expected to change. Markets expect the first interest rate cut from the Federal Reserve of this cycle, and that will be the first one that we've seen in more than 4 years. The only question in the eyes of financial markets is by how much does the Fed cut? Do they go for your typical 0.25% cut, or do they go for a larger 50 basis point cut? At the moment, markets are fully pricing the 25 basis point cut, and there's about a 35% chance that markets are ascribing to that bigger 0.5% cut. It's a tough one. I think the Fed would prefer to move in increments of 25 basis points. However, there is an argument that they should do a little bit more because we have seen some signs of a weakening labour market and there are still some risks to the economy. Then again, we did just get a slightly hotter than expected inflation report last week, at least at the core level. So it could go either way. It'll be very interesting to watch. In addition to the decision itself, we can also look forward to a new summary of economic projections from the Fed. That will be released at the same time as the interest rate decision, and we're expecting some changes from what we saw the last time we got an SEP from the Fed, which was back in June. It feels like a lot has changed since June. It won't just be the Fed that is releasing a monetary policy decision this week. We will also get one in the UK and one in Japan. So investors will shift their attention from the Fed to the Bank of England on Thursday evening, and that BOE decision will come a day after the latest UK inflation print, which comes out on Wednesday. The Bank of England cut interest rates for the first time last month, but markets expect it to hold fire this week and then for that easing cycle to resume in November. Then on Friday, we'll get the latest Bank of Japan monetary policy meeting. And this will be the first one since that July decision that set off the carry trade unwind and all of the volatility that went with it. No change is expected from the BOJ this week, but after the reaction that we saw back in July after that meeting, the tone of this one will be very closely watched. Here in New Zealand, there's a couple of things to keep an eye on. We will get the results of another dairy auction. That will be out early on Monday morning. A couple of weeks ago, the headline Global Dairy Trade Index did edge a little lower. It slipped 0.3%. That was the first decrease we'd seen in 2 months after prices rose about 6.5% during the previous 3 auctions. So we'll be looking for some more stability, maybe another increase. It was a bit of a mixed bag last time when you look across the various products. Whole milk powder was down 2.5%, but we saw gains in other areas. Bigger picture and zooming out a little bit, dairy prices haven't been too bad. The headline GDT index is up more than 11% so far this year, and prices have been hovering near 2-year highs in recent months. They're about 30-odd% higher than where they fell to in August last year. They hit a 5-year low in August last year. So it has been a fairly buoyant 12 months for dairy prices, and that's why you have had Fonterra increase its Farmgate milk price payout forecasts. We'll also get some new economic growth figures here in New Zealand, and this will be the key release on the local calendar, I think. GDP for the June 2024 quarter. This is out on Thursday morning, and it's likely to look quite subdued again, despite that bounce in confidence that we've seen lately. Remember, this covers April, May, and June, so it's before you had that Reserve Bank pivot in July, and it's certainly long before you saw that first OCR cut from August. And the confidence that you've seen in terms of lifting business confidence, consumer confidence, sentiment improving a little bit, all of that's happened more recently. These figures are a little bit outdated, and they're probably when we're at peak negativity. So it probably could look quite ugly still. Reserve Bank of New Zealand projections suggest that we'll get a 0.5% contraction in GDP, which would actually be the weakest in 18 months, and it would be the 7th contraction of the past 12 quarters. That would also mean that per capita GDP, which is once you adjust for population growth and so forth and back out those migration figures that have been quite strong, on a per capita basis, on a per household basis, that would look even worse. And we've seen 6 consecutive quarters where per capita GDP has declined. So it'll still look pretty ugly. I suspect it will still look quite recessionary. Financial markets and the economists out there are actually looking for a bigger contraction. They're looking for a 0.6% decline in GDP, which is higher than what the Reserve Bank is forecasting. They're forecasting a 0.5% decline. So it probably will be pretty ugly, and it probably will be pretty downbeat, the headlines that you see on the business pages on Thursday. It will tell us that we are still very much in recession, or at least that we were during the June quarter. That's pretty much it. There are a couple of other bits and pieces to look forward to. We will also get retail sales in the US. We'll get inflation reports in Europe and in Japan. I mentioned that UK one that is out before the Bank of England meeting. We'll get a labour force report across the Tasman, the August labour force report coming out in Australia. And on the corporate calendar, it is a little bit quieter than we've seen lately. Internationally, the FedEx result, that's always something I keep a close eye on. FedEx is one of those economic bellwethers. Their result comes out on Thursday. Here in New Zealand, a few AGMs, Manawa Energy, Turners, Mercury, New Zealand, a couple of those been in the headlines of late, haven't they? So a few things to keep an eye on. But other than that, it will be all about the Federal Reserve in the US. And here in New Zealand, I think it will be those GDP figures that will get the most attention. All right, thanks for listening. As always, team, we'll talk again soon.
For more insights, visit craigsip.com.